Hi, this is Steve Wolf, and today was an interesting day in the market. It started off that there was a lot of selling going on. The markets were taking a beating. It's coming back a little bit now, but I thought it was interesting because a lot of the earnings that have come out right now have been really, really good, and the guidance for the future has been really, really good. So why is the stock market not really rising? As a matter of fact, it seems to be, even though we've had some pretty good days and we've had some new highs, it seems to want to go down. Gravity seems to want to force it down. So, should we be selling into this or should we just hang on? Well, before we get into that, there's always a myth in the stock market world that says to sell in May and go away. And for those of you who may not have heard that, it has been around for a long time. And basically, how did this come about? How did the phrase come about as it relates to the stock market? So I was reading an article by David Bartosiak, who is from Zacks, and he's saying that the phrase sell in May and go away might have started in Old England, when the saying was really sell in May and go away, come back on St. Leger's Day. Now, St. Leger's Day was a time when there was a big horse race called the St. Leger Stakes horse race. And what happened was there was a bunch of wealthy Londoners who would go away from the city in May to get away from the heat, and they would come back in November when this race started. So American investors have kind of adopted this into the stock market, basically saying, sell in May and go away. So I was thinking here, is that the smartest thing to do? And in this particular article, David Bartosiak is giving statistics as to whether it makes sense or not. So one of the things is that the summer months usually have better returns in the stock market than the winter months. Don't really know why that is, but it is. So what Bartosiak did, was he went back 28 years using returns on the S&P 500 in order to showcase the gains and the losses. Over the last 28 years, he said that the month of May itself has returned on average about 81 basis points, or a little bit more than 0.8%. Now, that's really about average for what the market did over the last 28 years, because if you look at the returns, they've been about 10.4% per year, and it comes out to pretty close to what the month of May has done. Now, if you take the 8 periods over the last 28 years, where during the summer months, that May to November, that the market was down only about 28.5% of the time. That's 8 months out of 28 periods. But it also implies that 71.5% of the time the market was up. However, the down is usually a little bit higher than the ups, and especially because you had in the last 28 years, you had the '08 correction that was pretty big, close to 30% on the S&P 500. And we went through that real estate crash. But be that as it may, it happened, so we'll obviously leave that in there. So if you do the calculations and all that, what you could expect is about a 2.47% return based on those numbers that we just gave you. And I'm not a statistician, and for all you statisticians out there, you may say, hey, there's not a big enough sample, but we're going to go with it anyway. So your expected return is about 2.4%. Now, here we are today, and we have had the stock market that has been rallying. As I said before, the S&P and the Dow have gone up to record highs. So again, what's going on here? Well, I would tell you that there's actually two reasons I think that the market is still not doing what I think it should do with the earnings reports that we're talking about. The two reasons are inflation and a computer chip shortage. Now, inflation is starting to come about all over the place. I mean, if you just look at the price of oil, the price of food, I was looking around a little bit more. Commodity prices are on a tear. Lumber is up a lot. Steel is up a lot. And so I was looking at some of the other earnings, and Procter & Gamble, for one, came out and said that they're going to have to raise prices in September. And it's simply a matter of that their raw costs are going up, and they're just going to have to pass it along. Now, here's a company, it's a household goods company. They make razors and Tide, Gillette razors and Tide detergent and diapers and tampons. And it's the same thing that Kimberly-Clark said just a little bit ago, that they're also going to have to raise prices. one of the people who is the chief operating officer for Procter & Gamble and has been around for 33 years said, and this is from an article in the Wall Street Journal, that this is one of the bigger increases in commodity costs that we've seen over the period of time that I've been involved with this, which is a fairly long period of time. So inflation is happening. So what happens when inflation goes on in the United States? The way that the Fed tries to fight it is by raising interest rates. Well, the Fed so far has said that they are resisting that. They're saying that we haven't come fully back from the COVID issue, but although I do think we're on the downside. Interestingly, today, when the market really kind of dropped a lot today, and we're currently not down nearly as much. It's about, what time is it right now? About 11, yeah, almost 12 o'clock. So we still have about another hour to go in the market. But when Janet Yellen, in an interview with The Atlantic that was broadcast today, she was quoted as saying that big spending plans by the U.S. government could mean that interest rates will have to rise a little bit to make sure our economy doesn't overheat. When that news came out, the market went down by quite a bit. So no question that inflation will slow down the market a little bit because interest rates will slow it down. But I think that this is not something that I'm worried about yet. The second part of the reason that the markets are not doing as well as we thought they probably should do with all the great returns that we've had so far is that there's a chip shortage going on in all over the world, actually, globally. There's a chip shortage. And this chip shortage is causing a problem for a lot of companies, one of which is Ford. Ford just came out with earnings that were as good as you could possibly get. But their guidance was a little tepid. So people were a little confused by it. And the reason is because, for instance, they're going to have to, according to CNBC, they're going to have to cut out some factories for a while. They're going to have to shut them down. I think 5 different factories in the U.S. are going to have to shut down because they just can't build the car without the chips. Matter of fact, their best-selling and most profitable truck is the F-150 series. And according to CNBC, there are about 22,000 trucks that have been built without chips. Well, they can't sell them, but they will put those chips in once they're available, and then they can sell them. So revenues are going to be down, certainly for a while. But Ford did say, again, it's according to CNBC, that they think that the chip shortage should be ending by probably the end of the second quarter, although the impact will be felt a little bit longer. So I don't think these are long-term problems. I think that most of this is temporary. And if there is more selling that happens here in May, I would be a buyer. You know, I don't think that the stock market is going to take it on the chin when you've got lots of money that's sloshing around the economy because of all the checks that have been put out by the government, the $1,400 per person. It's a lot of money going into the economy, and revenues are great. I mean, things are really good, with the exception of the computer chip shortage. So bottom line here is I think we're good, and if going back to Mr. David Bartosiak from Zacks, what he says, and I agree with him, is when you hear sell in May and go away, ignore it. And I say to ignore it right now because I've got Mr. Bear over here. It's my little Chicago bear. And I can tell you that he is still hibernating. You know, he may be, toward the end of his dreams, but right now he's still hibernating. And I would stay with it. I would stay with the market. And as Mr. Bartosiak says, staying long and strong in the market is the best path toward long-term asset appreciation. So if you want to make money, hang in there is basically what he's saying. And over the years, the adage of sell in May and go away might have worked a few times, but in the long run, never bet against the U.S. stock market. So Mr. Bear, you can continue to sleep. We'll see you next time.